The numbers do not lie, the charts do not lie, the balance sheets do not lie, but for the last 3 years, the paper market has been lying to you about the true value of silver. Today, that lie is being exposed in real time. And the company doing the exposing is not some small exploration outfit nobody has heard of. It is the largest silver producer in North America. It is a company that just posted the most profitable quarter in its entire history. And its stock is telling you something that the mainstream financial media refuses to acknowledge. We are in the opening act of the greatest silver squeeze the world has ever seen. Right now, as I speak to you, Coeur Mining is trading at levels that make absolutely no sense if you believe the paper market is version of reality. This is a company that just reported $555 million in revenue for a single quarter. This is a company that just achieved a 54% adjusted EBITDA margin. This is a company that generated $189 million in free cash flow in just 90 days. And yet the valuation implies that silver is going back to $20. It implies that this entire industrial renaissance is a mirage. It implies that the solar panels and the AI data centers and the electric vehicles are all going to stop needing the most conductive metal on the periodic table. The paper market is wrong. And the people running Coeur Mining know it is wrong. That is why they are not just sitting on their cash. They are buying. They are expanding. They are positioning themselves as the strategic supplier to an entire industrial revolution. And today, we're going to dissect exactly what Coeur Mining's latest results tell us about the true state of the silver market. We are going to follow the money. We are going to connect the dots that Wall Street refuses to connect. And by the end of this analysis, you are going to understand why the so-called selectively bullish stance of the investment banks is actually a massive tell. It is the smart money's way of saying they know the squeeze is coming, but they do not want you to front or run them into the trade. Let us start with the Rochester mine. Because if you want to understand the silver market of 2026, you have to understand what just happened in Nevada. The Rochester expansion, internally called POA1, is not just another mining project. It is the largest open pit heap leach silver operation in North America. When Coeur announced this $730 million investment, the market was skeptical. The debt load was crushing. Net leverage peaked at over 7 times in 2023. Every analyst on Wall Street was asking the same question. Can they survive long enough to see the payoff? They survived, and now they are thriving. The Rochester mine officially hit commercial production on March 31st, 2024. By mid-2025, it reached its full design throughput of 88,000 tons per day. Let me put that number in perspective for you. 88,000 tons per day. That is enough rock to fill a football stadium every single week, and embedded in that rock is the silver that Samsung needs for its circuit boards, that Tesla needs for its solar roofs, that every data center in the world needs for its high-performance computing chips. The timing of this ramp-up could not have been more perfect. While Coeur was wrestling its expansion across the finish line, the silver price was beginning its historic ascent. We went from 24 to 40 to 60 to the current range between $60 and $80. And every single dollar of that price increase flows directly to Coeur's bottom line. This is what operating leverage looks like in a mining company. Their costs are largely fixed. The equipment is paid for, the workers are on salary, the heap leach pads are built. When silver goes from $30 to $70, the profit margin does not double. It quadruples, it quintuples, it goes vertical. And that is exactly what we are seeing in the numbers. In Q3 of 2025, Coeur reported a 54% adjusted EBITDA margin. Think about that for a moment. For every dollar of revenue, 54 cents is flowing to the bottom line before they even pay interest or taxes. This is the margin profile of a software company, not a miner. This is the margin profile of a business with pricing power, a business that is selling a product the world desperately needs and cannot substitute. But here is where the story gets interesting. Because despite these record-breaking results, the stock remains volatile. Coeur reported a slight miss on earnings per share in late 2025. The miss was minimal, it was noise, it was rounding error, and yet the stock dropped 8% in a single trading session. 8% on a company that just printed $189 million in free cash flow, on a company that is aggressively paying down debt, on a company that owns the largest silver mine in the United States. This volatility is not a bug, it is a feature. It is the market's way of shaking out the weak hands before the real move begins. The algorithms and the high-frequency traders and the paper pushers are using every trick in the book to create fear. They want you to sell. They want you to believe that the silver rally is over. They want you to hand them your shares at a discount before the next leg higher. Do not fall for it. The volatility you are seeing in Coeur mining stock is the volatility of a sector in the midst of a historic repricing. It is the volatility of a market where the paper price and the physical reality are diverging at an accelerating rate. And it is the volatility that precedes every major squeeze in commodity history. Let us talk about the acquisition of Silvercrest Metals, because this is the move that tells you everything you need to know about Coeur's as strategic vision. In early 2025, Coeur announced it was acquiring Silverest and its flagship Los Chispas mine in Mexico. Los Chispas is not just any silver mine, it is one of the highest grade operations in the world. While Rochester is a volume play, processing 88,000 tons per day of lower grade ore, Los Chispas is a margin play. It extracts exceptional value from a smaller volume of incredibly rich rock. By combining these two assets, Coeur has created something unique. It has created a diversified silver platform that can generate cash in any price environment. If silver drops to $40, Los Chispas keeps printing money because its grades are so high. If silver rockets to $100, Rochester becomes a cash volcano because its scale is so massive. This is not a company betting on a single outcome. This is a company that has positioned itself to win regardless of where the price goes in the short term. And let us not ignore the geographic significance. Rochester is in Nevada. Los Chispas is in Mexico. These are not the Congo. These are not unstable regimes where the government can nationalize your assets overnight. Coeur has deliberately built a portfolio and jurisdictions that respect property rights and the rule of law. As the world becomes more unstable, as resource nationalism spreads across Africa and South America, Coeur's North American focus becomes a strategic advantage that cannot be replicated. Now, I want to zoom out because the Coeur mining story is just one thread in a much larger tapestry. The real story is the structural transformation of the silver market itself. For decades, silver was dismissed as a monetary afterthought. It was gold's little brother. It was the metal you bought if you could not afford the real thing. That narrative is dead. It was killed by the solar panel, the AI chip, and the electric vehicle. Let me give you the numbers that the mainstream media is afraid to print. Solar panel demand for silver is approaching 300 million ounces per year. That is a staggering number. The entire annual mine supply of the planet is only around 800 million ounces. That means solar alone is now consuming nearly 40% of total production. And it is growing every single year as the world accelerates its transition to renewable energy. But solar is just the beginning. The new TOPCon cell technology that is sweeping through the industry requires 50% more silver than the previous generation. The panels are more efficient, they generate more electricity, but they also consume more of the metal that makes them work. This is not a problem that engineers can solve by substituting copper or aluminum. Silver has the highest electrical conductivity of any element. It is physics. You cannot argue with the periodic table. And then there is artificial intelligence. Every single AI query you run, every image you generate, every conversation you have with a chatbot is processed in a data center. Those data centers are filled with servers. Those servers are filled with chips. And those chips are connected with silver. The thermal and electrical properties of silver make it irreplaceable for high-performance computing. As AI demand explodes, as every company on the planet races to deploy these systems, the draw on the silver supply intensifies. This is why we are in the 5th consecutive year of global supply deficits. Let that sink in. 5 years in a row, the world has consumed more silver than it has produced. Every single year, the deficit has been covered by drawing down stockpiles, by raiding the vaults in London, by depleting the inventories in New York. But you cannot run a deficit forever. Eventually, the vaults run dry. Eventually, there is no more silver to raid. We are approaching that moment. The inventories in the major hubs have reached decade lows. The amount of silver available for immediate delivery has collapsed. And the companies that need this metal to run their factories are starting to panic. They are signing long-term contracts at prices far above the spot market. They are locking in supply for 2027 and 2028 because they are terrified of what happens if they cannot secure their allocations. This is the backdrop against which Coeur Mining is operating. This is why their Q3 results are so significant. They are not just making money. They are making money at the precise moment when the world is realizing it does not have enough silver. They are generating cash at the precise moment when industrial giants are scrambling to secure supply. Coeur is not just a mining company anymore. It is a strategic asset. Let us talk about the debt situation because this is where the transformation becomes undeniable. In 2023, Coeur was struggling. Net leverage was over 7 times. The Rochester expansion had consumed enormous amounts of capital. The balance sheet was stretched to its limit. Every credit analyst on Wall Street was watching with their finger on the downgrade button. Fast forward to late 2025. Coeur has slashed its debt from over $600 million to approximately $370 million. They have paid down nearly $230 million in just 2 years. And they did it not by diluting shareholders with equity raises. They did it with cash flow. Pure organic generated from the mine cash flow. This is the mark of a company that has crossed the river. They were on the dangerous side, weighted down by debt, vulnerable to any price decline. Now they're on the safe side, generating enough cash to strengthen the balance sheet while still investing in future growth. The analyst projections for 2026 suggest that net leverage will drop below 1.5 times by the end of the year. At that point, Coeur will no longer be a leveraged speculation. It will be a mature cash-generating producer that just happens to be perfectly positioned for the silver supercycle. And when that re-rating happens, when the market finally acknowledges that this is not the Coeur of 2023, the stock price will have to adjust violently. Now, let us address the elephant in the room, the paper market. Because if you're only watching the spot price on your screen, you're missing half the story. The spot price of silver is determined by paper contracts traded on the COMEX and other futures exchanges. These contracts represent theoretical silver. They are promises to deliver metal at some future date. But here is the dirty secret. The vast majority of these contracts are never settled in physical metal. They are rolled forward month after month, creating an artificial supply that exists only on a spreadsheet. This paper supply has allowed the banks to suppress the silver price for decades. Whenever the price starts to rise too fast, they simply sell more paper. They create more contracts out of thin air. They flood the market with theoretical silver that does not actually exist in any vault anywhere on the planet. It is a magic trick. It is a con game. And it has worked beautifully for a very long time, but the game is breaking down. The paper market is starting to diverge from physical reality. We are seeing premiums on physical silver that would have been unthinkable just a few years ago. Try to buy a silver eagle at the spot price. You cannot. The premium is $15 or $20 over spot. Try to buy a 1,000-ounce bar for immediate delivery. Good luck finding one. The dealers are quoting 6 to 8 week delays. The mints are back-ordered. The refiners are running at full capacity and still cannot keep up. This divergence is the market's way of telling you that the paper price is a lie. The real price, the price at which you can actually acquire physical metal, is much higher. And that real price is converging with the industrial price being paid in Shanghai and Dubai and Singapore. The arbitrage is collapsing. The fiction is being exposed. And when the paper market finally capitulates, when it admits that its theoretical supply cannot satisfy real-world demand, the price discovery will be explosive. Kermaning sits right at the intersection of this transformation. They do not produce paper silver. They produce real silver, physical ounces that come out of the ground and go into refineries and emerge as bars and rounds that can be held in your hand. Every ounce they produce is an ounce of genuine supply in a world drowning in paper claims. This is why the industrial buyers are locking in contracts with Coeur years in advance. They understand what the retail investor is only beginning to grasp. The paper game is ending, and when it ends, the companies with actual metal will be the kings. Let me talk about the competitive landscape, because Coeur is not operating in a vacuum. There are other silver producers watching the same trends and positioning for the same opportunity. Hecka Mining has been a beneficiary of the price surge. Their high-grade underground operations offer a different risk profile with higher margins on a per-ounce basis, but less scalability than Coeur's open-pit model. Pan American Silver has a larger global footprint, but faces geopolitical risks in jurisdictions like Argentina and Bolivia. First Majestic Silver has been expanding aggressively, but carries more debt than the market is comfortable with. What sets Coeur apart is the combination of scale grade and geographic safety. Rochester gives them volume. Las Chispas gives them grade. North American jurisdiction gives them political stability, and the recent debt payout gives them financial flexibility that most of their competitors simply do not have. When Goldman Sachs talks about being selectively bullish on silver miners, Coeur is exactly the kind of name they are selecting. But do not mistake the investment bank's caution for bearishness. When they say selectively bullish, they are not saying they dislike silver. They are saying they want to own the winners and avoid the losers. They are saying the days of throwing darts at a list of mining stocks are over. They are saying that operational execution matters, that balance sheet strength matters, that geographic risk matters. And on every single one of these metrics, Coeur is at the top of the list. Now let us look forward, because the real question is not what has happened. The real question is what comes next, and the answer depends on whether you believe this is a temporary spike or a structural shift. If silver prices stabilize in the $60 to $70 range, Coeur will continue its debt reduction program. By the end of 2026, net leverage will be below 1.5 times. The company will likely initiate a dividend or a share buyback program. The stock will gradually re-rate higher as the market recognizes the transformation from a leveraged speculator to a mature cash generator. This is the base case. This is the scenario that the conservative analysts are pricing in. But there's another scenario, a scenario where silver does not stabilize, a scenario where the industrial demand continues to outstrip supply, a scenario where the solar manufacturers and the AI companies start to panic buy, a scenario where the physical shortage reaches a breaking point. In this scenario, silver does not stop at $80. It blows through $100 and keeps going. It goes to $120, $150, maybe higher. The paper market breaks completely. The COMEX declares force majeure and settles contracts in cash because they do not have the metal to deliver. The premiums on physical silver explode to 50% or 100% over the spot price. The mining stocks go absolutely vertical as investors realize they are the only source of new supply in a world that is starving for the metal. What does KUR look like in this scenario? Their margins expand to 70% or 80%. Their free cash flow quadruples. They could pay off their entire remaining debt in a single quarter. The stock could triple or quadruple from current levels. And this is not wishful thinking. This is math. This is what happens when a low-cost producer meets a parabolic price move. Watch the futures curve. If you start to see backwardation, where the spot price is higher than the future price, that is the signal that the physical shortage is reaching critical levels. It means buyers are willing to pay a premium for silver today, rather than wait for delivery tomorrow. It means the trust in future supply has evaporated. It means the squeeze is here. We are already seeing the early signs. The spread between Shanghai silver prices and New York silver prices has been widening. The premiums in the Middle East have been elevated for months. The dealer inventories in the United States are at multi-year lows. The mints are quoting extended delivery times. The refiners are running out of scrap. Every single indicator is pointing in the same direction. Industrial consumers are starting to feel the pain. First, solar has been scrambling to reduce silver usage in their panels. Apple has been exploring alternatives for their device components, but there are no good alternatives. Every substitute is either more expensive, less effective, or not available at scale. The manufacturers can complain about high prices all they want. At the end of the day, they need the metal, and they will pay whatever it takes to get it. This is the feedback loop that drives commodity supercycles. High prices cause demand destruction at the margin, but the core demand is inelastic. The solar farms still get built. The data centers still get powered. The electric vehicles still get produced. And every single one of these applications requires silver. The only question is how high the price has to go before the market finds equilibrium. Based on the current supply deficit, based on the inventory drawdowns, based on the industrial demand growth, I do not think we have found that equilibrium yet. I think we are still in the early innings of this move. Now let me address the risks, because no investment thesis is complete without acknowledging what could go wrong. The first risk is a global economic slowdown. If the world enters a recession, industrial demand for silver could contract. The solar installations could slow, the AI spending could moderate, the electric vehicle sales could stall. In this scenario, silver prices could correct sharply, Coeur's margins would compress. But here's the counterargument. Even in a recession, the structural trends driving silver demand do not reverse. The grid still needs to be upgraded. The energy transition still needs to happen. The AI investments still need to be made. These are multi-decade megatrends, not cyclical phenomena. A recession might slow the pace of growth, but it will not change the direction. The second risk is a surge in supply. If silver prices stay elevated, marginal producers will bring new capacity online. Mothball mines will restart, recycling will increase, exploration spending will accelerate. Eventually, the supply response will catch up to the demand, but this takes time. Mining is not software. You cannot spin up a new silver mine in a quarter. The permitting process takes years. The construction takes years. The ramp up to full production takes years. Even if every mining company in the world decided tomorrow to maximize silver output, it would take until 2030 or later before meaningful new supply hit the market. And in the meantime, the deficit continues. The vaults continue to drain. The squeeze continues to intensify. The third risk is technological substitution. What if the engineers figure out how to make solar panels without silver? What if they find a way to build AI chips with copper or graphene instead? This is a legitimate long-term risk, but it is not a near-term risk. The manufacturing infrastructure is built around silver. The supply chains are designed for silver. Switching to an alternative would require billions of dollars in retooling and years of research and development. It is not happening in 2026 or 2027. So yes, there are risks. There are always risks. But the risk-reward profile favors the bulls. The downside is return to $40 or $50 silver, which would still be profitable for Coeur at their current cost structure. The upside is $100 or $150 silver, which would be transformational for the entire sector. The asymmetry is overwhelming. Let me bring it back to Coeur Mining specifically, because they have done something remarkable over the last 2 years. They have taken a company that was on the brink and transformed it into a dominant producer. They have navigated the most capital-intensive phase of their expansion. While the market doubted their survival, they have emerged on the other side with a world-class asset base, a strengthening balance sheet, and exposure to the most compelling commodity story of the decade. The Q3 results are not a fluke. They are the new normal. The $555 million in revenue is repeatable. The 54% EBITDA margin is sustainable. The $189 million in free cash flow is the beginning, not the end. As Rochester continues to optimize, As Los Chispes continues to contribute, as silver prices continue to rise, these numbers will only get better. And yet, the market remains skeptical. The volatility persists. The doubters abound. They point to the history of silver crashes. They point to the leverage of the past. They point to the unpredictability of commodity markets. And every time the stock dips 5% or 8% on a minor earnings miss, they nod their heads and say, "I told you so." They are wrong. The history they are citing is the history of a silver market that no longer exists. The silver market of 2026 is not the silver market of 1980 or 2011. It is not a speculative playground dominated by paper traders and momentum chasers. It is an industrial necessity dominated by manufacturers who cannot operate without the metal. The fundamentals have shifted. The demand is structural. The supply is constrained and the price is going higher. Coeur mining is your vehicle for this trade. It is not the only vehicle, but it is one of the best. It has the scale. It has the jurisdiction. It has the management team. It has the balance sheet. And it has the operating leverage to magnify every dollar move in the silver price. The volatility you see today is the volatility of a market in transition. It is the volatility of a repricing event. It is the volatility that separates the weak hands from the strong hands. The weak hands sell on every dip, terrified that the party is over. The strong hands buy on every dip, understanding that the party is just beginning. Be a strong hand. The squeeze is here. The fundamentals are undeniable. The industrial demand is insatiable. The supply is constrained. The paper market is breaking. And Coeur is sitting on top of the largest silver mine in North America, printing cash at a rate that would make a tech company jealous. This is not financial advice. This is not a recommendation to buy or sell any security. This is information. This is analysis. What you do with it is your decision. But make no mistake about what is happening in the silver market. We are witnessing a once-in-a-generation transformation. We are witnessing the repricing of an essential industrial metal, and we are witnessing it in real time. The mainstream media will continue to ignore the story. The paper traders will continue to suppress the price. The banks will continue to play their games. But the physical market does not care about their games. The factories need silver. The solar farms need silver. The data centers need silver. And they are going to pay whatever it takes to get it. Coeur Mining's Q3 results are the proof. $555 million in revenue, 54% EBITDA margin, $189 million in free cash flow. These are not the numbers of a company in distress. These are the numbers of a company at the center of a supercycle. And the stock price has not yet caught up. It will. The question is whether you will be positioned when it does. Stay focused, stay patient, stay positioned. The silver renaissance is here and Coeur is leading the charge.